Hi everyone, this is KT here. So today video it's about telling you when to change your options position. So have you ever wondered when to close, roll, or reset your options trades? Well, most people will rely on gut feel, and that's why they hold too long or they'll give back the profits or get hit with assignment. So today I'm going to show you the exact Excel template I built that will give everyone clear rules and how everyone can use it to manage the trades like a professional option trader. So if you take a look at this spreadsheet here, I have the different types of options that I'm going to sell here. And in the data sheet, the different definitions of the options are stated here. Like CC is a covered call, CSP is a cash seeker puts, and of course NP naked puts, NC naked calls, and so forth. And in this data sheet here, I have the different stocks and their current market price, which will need updating daily. And also, I have a table to calculate how much premiums I will gain by selling options per week. So back to the template here. I am using this spreadsheet for selling options and getting a premium for doing so. Next, I have a row, no, a column, column B, which I enter the stock ticker here. Later, I'll give an example here on row 4 on one of the trades that I made. Just need to know that the strike price is the price that you sell your options at, and then automatically it will populate what is the current market price. You enter the number of contracts in, and automatically in column F, it will show how many quantity of shares. And one contract is equals to 100 shares. And the total capital that you need to fork out if your options is in the money and you get assigned. And here is the corresponding options premium and the total premium collected here. Uh, and what's your ROI weekly, your ROI monthly, whether are you buying or selling options, what are your options title, the month, the year and the date, and also the strike price, and is it a put or a call? And the break-even price is actually equals to the strike price that you sold your options. This is important because it will help you to remind you whether the break-even price, uh, because I'm running a wheel strategy. So let's say if I get a sign when I sold my puts, which is expire in the money, then I will sell another call option at the break-even price so that when it becomes bullish, it will get caught away. Next, I will input the bid price for selling my options here, and daily I will input the ask price to see how many percentage value is left. And option status depend on a put or call that you sold, and it will tells you out of the money or in the money here. Okay, and total capitals, how much is it here? And what's your net liquidation value, your margin, your weekly ROI, monthly ROI, and the number of shares here, and how much total capital of your assigned stocks, your cash on hand, what's your account true value, and any changes, and the true value estimated end of the month here. Okay, so let me just show an example here. So I will take a look at the trades that I have placed last week. Let's look at CRM, September 12, 25, 250 puts. So I sold 5 at 8.56. So here, uh, it's a cash secured put, so I will put CRM here. Uh, and then I will put, oh, okay, so there's a formula here. I will just need to copy here. Okay, so CRM, strike price 250, one contract, 100 quantities, 25,000 capital. Premium gain, it's 8.56 here. So I'll put 8.56 here. The ROI weekly is 3.4%, ROI monthly is 13.7%, and I'm selling. So it's September 12th, 25, 250. September 12th, 250, 8.56. So let's take a look at what is the bid price now. So we look at the portfolio here. If you look at CRM now, it's $8 and 8.3. We take the in between is 8.15. 8.15 here. So my percentage value left is actually 95% here. So with this number in mind, let me explain more on the premium decay rules here. Before I go on, as I mentioned, I'm in the option selling game. I love to collect the premium, but there's a danger here because if I hold too long, my theta slows, and then gamma rays will explode. And if I cut too early, I'll leave profits on the table. So without a framework, I'm basically driving a car without a speedometer. So here's the solution, which it's my premium decay rules. And I built my options position management spreadsheet revolving around these rules. So if the option premium drops by 50%, that's my profit sweet spot. So I will actually harvest the gains or I roll forward. This to me is like changing the options position. For me, every time I change an option position, I will gain premium. So I love to change my options position. The more, the merrier. And next rule, if the premium doubles against me, like more than 100%, like you see this, 175%, then I would try to change my position to roll down or roll up to avoid assignment. In this case, I am resetting both to 100% value. So basically, there is two principle. If you don't want assignment, there are two factors. One is either to roll out, which is to extend the day of expiration. Like example, September 12th, 2025, you roll out to October 17th, 2025. The probability of getting assigned is lesser. And you can roll down, you reset the strike price to the market price. So let's say I would have Kim's at $46 strike price, but the market price is 42.57. So I can roll down to 41 or 42 to avoid assignment. Okay. Next, I'll talk more about the Greeks. So in options, there are quite a couple of Greeks here, but I'm just going to focus on these three main Greeks, which is theta, delta, and gamma. So let me explain in simple terms. Theta is actually the decay curve, the time decay. It tells you how much an options value drop each day just because time is passing. So you imagine it's like an ice cube melting. And at first, it melts slowly, but the closer you get to expiration, the faster it melts until nothing is left. So, example, if I sell a 30-day options for $3, at 20 days it's worth $2.20. At 10 days it's worth $1. And at expiration it goes to zero if out of the money. So let's say at 10 days it's worth $1. I sold a 30 days option for $3. If I choose to close it just by buying back the position, I will earn $3 minus $1, $2 credit. And of course, if I hold it to the end and it expires out the money, I will gain the whole $3 premium. Next, delta is the stock exposure. So it's a directional risk here. So whether it's a negative or positive delta, it means a different direction. So delta is like my steering wheel. It tells me how much stock I'm really holding through the option. So example, if I sell a put with delta negative 0.2, it behaves like you have long 20 shares. If the stock falls and the put goes in the money, delta climbs to negative 0.8. And now I'm basically long 80 shares per contract. So same thing for a short call at plus 0.80 delta, I'm basically short 80 shares. So I have a video that talks about delta versus probability of profit. Just to reiterate, I would prefer selling options at the delta 0.1 to 0.3 and 0.1 in between 0.1 and 0.3, or I'll look at probability of profit that's more than 80% or more than 85% here. The probability of profit has a inverse relationship with the number of premium gain. So the higher the probability of profit, the less premium you will earn. Next, we talk about gamma, is the acceleration risk, how fast delta changes. So imagine I'm driving a car, gamma is like the gas pedal. It measures how quickly delta changes when the stock moves. So with 30 days left, a $1 stock move barely shifts delta. But with 2 days left and the option at the money, $1 move can flip my exposure from long 20 shares to long 50, and the next move to long 80. That's why small moves near expiration can swing my P&L violently. Usually, I would try to avoid gamma risks here. So, like if I left with 2 days, I would try to change my positions here, unless I'm very sure that it's going to expire out of the money. So, that's pretty much here. So if you like to use this spreadsheet for your own trades, just email me directly. For a small fee, I'll send you the download link along with a step-by-step video tutorial that shows you exactly how to set it up and apply it in your trading. So that way, you're not just getting a file, you are also learning my full framework here. So I'd like to end this video with just to say that options trading isn't just about entries, it's about management. And this spreadsheet gives you the discipline most traders lack. Well, if you want your own copy plus my video walkthrough, just email me. Details are in my YouTube channel description. And if you find this video useful, just remember to click the like button and subscribe to my channel. Yep. And so I think that's all. Have a great day, everyone. Signing off here.